Hello and welcome to the Harwood Report for November 6, 2017, presented by Trade Academy. I am your host and the founder of Trade Academy, Keith Harwood. Standard disclosures to start. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. What this really means, obviously, is these are not trade recommendations. These are things I am looking at before you enter into any trade. Consult your financial advisor. Options have risk. Do your own due diligence before doing any trade. None of this is advice from me. It is how I'm looking at the markets. I'm going to go over the equity indices. I want to look at TLT, and then we're going to do our normal focus on gold and oil and places that I'm looking at potential trades in those two, just because that's really where I'm rotating my focus here, particularly for the free stuff. Gold, oil have a lot of opportunities, and I think that they're generally very interesting as a result. First things first, before I go into the macro indices, you can see that fear and greed is down to 66. The market's making new highs every day, and fear and greed's coming down. Why is this happening? Small caps aren't necessarily rallying. We've got a little bit of sector rotation, so there are reasons why this is not sitting in the 90s like we saw a month ago, even though the markets continue to make new all-time highs. The market's drifting higher, not spiking higher. Yes, I know tech sector did really well last week with Apple's earnings, but generally speaking, this is not a bad sign for the market. It allows for more sector rotation and continuing drift higher. So we look at SPY and it's pretty clear to me. We don't ever close below the 20-day moving average, and when we do, that's our flag. Until then, it is a grind higher, and it's a slow grind higher. This is not a long outright options play for me. The long outright options play is when I'm looking for the bearish side. On the bull side, there are some nuanced trades that I'll go over in the newsletter that I do every week for the premium subscribers. I'm not going to talk much about it here. Basically, I just expect the macro indices to continue to drift higher until something changes, and that something would have to be either really bad news somewhere on the market, or we get so overbought that there just is a consolidation pullback. Bad news would be something macro like war or abandonment of tax reform or something like that, and that just doesn't seem imminent right now. So let's go to individual sectors where there might be a little more interest. The Qs are a little bit more frothy here. So the big rally off of Amazon and Facebook earnings. Google earnings, Amazon and Google earnings. Friday we had a good move off of Apple earnings. Facebook earnings were kind of a non-event. Tech's fine. Everything's going to be good in tech. It seems like right now tech is still just going to be the leading sector for us. Semiconductors have been very good. The news this morning was that Qualcomm has an unsolicited takeover offer from Broadcom. There's still consolidation in the tech sector. There's M&A in the tech sector. It means that these businesses are still seeing value in the tech sector when they do their deep dives. Investment bankers are finding value here. Hedge funds are finding value here. I think that the tech sector is going to continue to be the leader, but there can be some rotation in the short term. So in the day-to-day basis, I don't know that the tech sector, that the Qs are going to get above 155 this week. Maybe they do if something good comes out that just drives everything higher. But I'm not necessarily looking at this as an explosion higher. It's, again, a grind higher and maybe more likely to even be sideways. The one that needs to play some catch-up is the small caps. So small caps have been very sideways down over the last, 5 weeks now? That's not fun for people looking in the small cap sector. But one of the things that we see is that small caps tend to perform well when the dollar performs well and when financials perform well. So let's look at the dollar. The dollar has been firming and small caps really haven't been playing. XLF has been, a little firmer, but not incredibly firm. In general, it seems to me like the most logical trade here is going to be that as portfolio managers start to hunt for value, they're not necessarily going to find it in the techs in the short term. They're going to look towards those small caps because of things like tax reform. If tax reform comes through, that's expected to be very bullish for small caps. We're still trading in a box, but you can see it's widening here. So we've got that same upside here. And this is starting to get a little bit wider on the downside. So we're increasing our ranges here. This is actually becoming a bit more of an interesting play from the option side as a result. I think volatility can start to increase in IWM once we get a breakout. So move above The high on November 1st, a move below really the, this level here at 148. That gets me more excited for a potential trade here with long outright options. Until then, I'm looking at probably calendars or something like that. But right now, this is not an exciting optionalized trade. And then, as always, the Dow Jones Industrial Average looks like the S&Ps. There's nothing really to talk about here. Markets are wider than the S&Ps. I'm not going to look for anything too crazy there. So before I get into the commodities, I want to look at TLT. It's doing something a little bit interesting today. It is trading above all the key moving averages now. So in the past, when we've retested, the 50-day moving average, it's kind of provided some resistance there. Yields, to me, shouldn't necessarily be coming down if tax reform's on the table and things of that nature, but yet we're seeing them coming down. Powell was named the next Fed president last week. So it removed that concern about John Taylor coming in and ramping up rates. If this closes above these key moving averages, it starts to put a little bit of a flag into the dollar trade and into small caps, because lower yields is generally going to create a little bit of weakness for the dollar. So the higher TLT goes, the lower the dollar goes. And that would also put some bullish potential price action into the precious metals. So this is something I need to be very aware of. If TLT fades back below the 50-day moving average, which right now is at 125.62, so basically goes negative on the day, that's going to be a really key signal for me that it's time to put potentially some more money into puts in precious metals or calls in XLF. So speaking of precious metals, the real key dollar indicator that I've been watching is dollar yen. It's chopping, but it's above the 10-day moving average, and it's still there. It looked like overnight this was going to take off, and if it had taken off, that would have been incredibly bearish for the precious metals. You can see the high on that day was 114.51 in July. The highs in here were around 114.40, and the high today was 114.73. So we've got this potential for that breakout move into the 116, 117 range. I've heard a lot of people say that fundamentally this has no purpose being up that high. It doesn't matter. It doesn't. If all this stuff is driven by central bank action, then central banks do what they want, and they drive the fundamentals. They drive the price action. So if dollar yen continues to stay above the 10-day moving average, I'm going to be looking that much more aggressively at the bearish side of precious metals. Gold, it looks to me like it's got a problem. So I'm looking now, I've got two sort of signals here, TLT fading, which it's actually starting to do right now as we speak, a little bit down towards 125.92. Dollar yen firming, still above the 10-day moving average, so I'm thinking, okay, I want to approach from the short side on precious metals. And GLD is close to these recent lows, 119.78, so we're about a buck away. And get in early if TLT starts to fade and gold doesn't fade. On the short side there. So GLD, and I'll come back to the options on that in a minute, because that's actually where I like the option side. But I want to look also at normal, as I normally do, silver. That had a great pullback on Friday. That's now a little bit more normalized. I think it still has more downside to go, but I think GLD is the cleaner trade because it's gold. And now that silver has pulled back a little bit relative to gold, it makes more sense for me to stay with gold as opposed to silver, which kind of trades as a derivative of gold. I'm bearish on both. I'm already long puts in silver, SLV, but I'm going to be looking for puts in GLD now. Miners have been just garbage. They're getting a little bit of a bounce today, but we can see that there's just really not much changing here. And if gold falls out of bed, these fall out of bed too. If gold firms, we're testing the 10-day moving average here. Maybe this can get a pullback up all the way to 24. So if I was going to go on the bull side, I actually do like doing it in GDX with vol cheap, but right now it's a wait and see game. I need to see the dollar yen fade back below the 10-day moving average, which is around 113, before I would really consider doing something there. GDXJ is very much similar to GDX. It's just a little bit more extreme, and it's been a little bit more bearish because with gold prices here, there's not been a lot of reason to get into the junior gold miners. So let's go back to GLD. We see right now we're trading 120.80. It's right here. a buck break really becomes a problem for it, as that can drive. If a move down $1 could be a trigger to get another 2 to 3 below that. When I look at the options in GLD, let's go over to GLD. Let's look at the vol here. 9%, it doesn't really get cheaper than 9%, and I get it. The realized vol has been 8%. But if you got the direction right, you know, the difference between 8 and 9% isn't massive. If I look at December 1st, I can actually get pretty close. I mean, I can get under 9% if I go into the December 1st 119.5 puts, for example. So that's kind of where I'm looking here. I'm thinking, okay, if I can get these December 1st 119.5 puts today, under 9% volatility, we start to break, then I'll look towards turning this into a diagonal maybe and sell some November 17th 119 puts, which are closer to 10%. So that's an interesting trade for me, but the real key is looking at the December 1st 119.5 puts. That is the outright play for something a little more defined risk. I'll look towards that diagonal. So that's how I'm really approaching the precious metals right now. It's very GLD focused. I mentioned GDX, and I just want to bring up GDX vol here again. It seems to actually be stabilizing here around 20%, but as I mentioned a number of times, this vol is incredibly cheap. And that's why I think if I change my opinion here, I'll maybe be looking on the call side here for GDX as opposed to for GLD. This vol, you know, in the sub 20% range is just incredibly cheap. Let's go back to the charts here. I want to go over to oil. So we'll start with USO. Just an incredible run here, above all moving averages, all the momentum's higher. If we actually look at it in the futures, you can also see it here. It's, I mean, this is, you know, a clean breakout. There's nothing stopping this, it seems like. If I go to a monthly chart just so that we can get some longer term view here, we really haven't been trading in this range since June of 2015 in terms of absolute price level. If we get above that that level there of 62.58, I mean, whew, that's going to create another big spike. That's a little ways away. That's, you know, we're going to be, I don't think that's going to happen in the next week or two. But there's a lot of stuff going out there, everything going on with Saudi Arabia and everything else that's maintaining a bullish bias in crude. And because of this, I have to have a bullish lean in XLE. And right now, XLE is not nearly as bid up as crude. You can see this MACD on the daily has just crossed. This is getting exciting for me. I want to look at the options in XLE. I think there's a trade here because of where vol is. Vol has firmed to 14%, quote unquote firmed. If I look back a year, you know, we're talking about 17-ish% as the normal range. Again, it's been a little bit lower realized volatility, so I don't want to necessarily be too short dated on this, but if I can get vol for December 8th at 14.5%, that gives me a great opportunity. And so I'm going to look at these December 8th 70.5 calls for 14% volatility if they can get a little tighter there. If not, I'll go back towards December 22nd. You know, I got to get a mid-market value here, and that's the problem with some of this stuff. December 15th may play better, but the vol's a little higher. All right, now I want to look at OIH because it's a bit more leveraged to the price of oil here. It's already gotten a 2% rally today, but if I look at that chart, let's look at it over here. We can see that we're now above most of the key moving averages. We still got the 200-day above us around 27 bucks. You know, last week I was looking at this for a move towards 26. I'd like to see that break through that level, and if it does, I mean, I don't even know if the 200-day moving average can create a lot of stopping point, but above 26, I'm targeting 27. It sounds weird to say that, okay, well, once it moves up 75 cents, I think we get another dollar. That's the nature of the beast when it's in this bullish run here. And I think that we're kind of repeating sort of what we did here. And so I'm looking for that move towards 26.5 still, with potential upside beyond that if oil continues firm. And so since vol is relatively cheap, it has come up a little bit just like in XLE. I can look back into November 24th. You know, the 26 calls here for 22 cents are not at all expensive. It's 22% vol. So that's kind of where I'm going to be looking is the November 24th, 26 calls around 22 cents. That gives me some good upside at a really cheap volatility, especially if oil continues firm over the next week or two. I think that there could be some big money flow into oil as a sector. All right. So that's it for us for today. Covered a lot of stuff, but basically, as I said, I'm looking for SPY to just continue to drift higher. Qs maybe a little consolidation. IWM I think needs to play some catch up, particularly if the dollar stays firm. TLT is a good signal of that. And if TLT starts to break and dollar continues to firm, it's going to be really good potential here for a bearish gold play. Focusing on GLD to stay with the most consistent performer on the dollar move, but recognizing that if that trend flips and dollar starts to weaken and bonds start to firm, then I want to be looking in gold miners because they're so cheap relative to gold. And if gold spikes, there's going to be a lot of momentum flow into the miners. Oil-wise, I like calls both in XLE and OIH. I like them roughly equally because of where volatility is. But I think both of them could create some good explosive upside for me. And so I'll be looking at calls, outright calls in both XLE and OIH this week. Reminder, this video that I've just done is free. I also do a premium version of the Harwood Report. I go into a newsletter. I outline a lot more trade ideas that I'm looking at. And I think they're generally been pretty good, especially in these commodity plays. I also talk a little bit more about things like calendars, diagonals, things that are a little more nuanced, but create explosive return profiles without just being outright options. They help reduce the risk a lot of times there. I also do a midweek update that's premium only, and I talk a little bit about how to pick the best option structures for each setup for these subscribers. So if you sign up now, there's a free 1-month trial. There's no risk to you guys. If you don't like it, cancel. If you do like it, then it goes up to $49 a month, which is also very cheap. So I hope you guys have appreciated and enjoyed the free video and are interested in potentially going into the premium product, which again, you get a free month. So no real risk to you guys. It just gives you an opportunity to test out what else I add on in the for premium subscribers. As always, you can contact me. Emails keith@tradeacademy.co. That's the easiest way to reach me. And again, it's .co, not .com. Phone number is 312-600-8004. And follow me on Twitter @TradeAcademyCo. I have watch lists and things that are more individual equity focused, but I do talk about some of the macro stuff there as well. Thanks a lot, everybody, and we'll talk to you next week or a little later today and on Wednesday if you sign up for the premium newsletter. Thank you.